But Bryan received his PhD from the University of British Columbia, so he's one of our Canadians on the faculty and very proud of it. And is a chartered accountant as well, and he's going to talk a little bit about his background as he goes through the story, but one of the most impressive things about Bryan is that he loves to teach. He has a great passion for teaching and a great rapport with our students here at the Tepper School, and he received the teaching award from our students. They select a teacher each year to receive that award. He was one of our award recipients for excellence in the master's program and has authored some award-winning research on commodity prices. So we're delighted that he's taken time out of his busy schedule to be with us this afternoon and to host our panel. So welcome, Bryan. Thank you.
So thank you to all the panelists. So I will introduce them momentarily, but before I introduce our panelists, let me introduce the hedge fund industry to you. So this is 2 slides, and then we'll get back to our panelists, because people are not that interested in hearing me speak. So let me show you 2 pictures, which are basically phenomenal on those. So here is the money flowing into the private equity industry from 1990 onwards on those, which is impressive on those. The little blue spike in the center is the .com bubble on those. But you can see that this is just sort of phenomenal growth. And so this is money flowing in on this. You have to be careful about how you measure these, because this is sort of money committed. It's hard to measure money spent. These are all sort of private organizations, and so reporting is not always consistent on those. Hedge funds, the data on hedge funds was a little harder to get. I had to click on the second link in Google instead of the first link on those. So here's a picture of, this is assets under management on those. This picture is so good it goes out to 2008. So I'm not exactly sure how much faith you want to put into it. And the line from 2005 to 2008 looks pretty smooth, so I'm guessing that their growth algorithm was not too thoughtful. The gist is, it's now a lot of money. But that's kind of out in the world. What about here at the Tepper School of Business? Is hedge fund sort of the way of the future? Well, we now have a hedge fund club here at the Tepper School of Business. This is their very impressive logo on those. I'm not sure if they dealt with the our graphic design people over the next building over to get this done. But this is their logo. We now have a hedge fund club. I didn't know we had a hedge fund club until a year or so ago. So I'm guessing this is pretty new. But here's the picture which I thought was the best, which is, how's the hedge fund club doing? It's taken over. So this is the picture of the sign. You'll notice the hedge fund club is right next to the investment club. And the investment club is not looking too healthy. So, and it's just kind of spilling over on those. I've forgotten who is moving off on the left on those. I didn't want to, insult our friends in marketing or something like that. But basically, they're taking over on those. Okay, that's it, growth. So let's go back to our 4 panelists. Let me briefly introduce each of them. They'll each take a minute to say a few words, then we're going to open this up to questions on those, because I'm assuming that everybody here has lots of smart, intelligent questions to ask on those. Particularly current students have smart, intelligent questions to ask, and so they've been so challenged with that task. So our panelists, our 4 panelists, are all alum. They're all alum from back when we were called GSIA on those. So on my far right is Bill Wong, who's an alum from 1990. On those, he worked at Hyundai Securities and Peregrine Securities for a while before joining Tiger Management as an equity analyst. But he's now the owner managing partner of Tiger Asia Management, which is focusing on equity strategies in Japan, Korea, and China. Next door is, one this way, is Remo Jolly. Remo graduated here in 95 on those. Worked a bit for Deutsche Bank in structured equity products, and has now moved to Citigroup, where he's basically a broker to the stars, broker to the hedge fund industry, which is, remember, all these hedge funds are going to be highly levered, so this is about lending money to people who are highly levered is a stressful thing to do. So that's what he does. Next door is Jerry Temas. Jerry graduated our MSIA degree from 1985 After a brief stint in our, we tried to convince him to get a PhD, but Goldman Sachs tried to convince him to earn some money on those. That kind of won out on those. So he is, I think, of our panelists, the only panelist with a publication in the Journal of Labor Economics on multi-period wage contracts and productivity profiles, co-authored with Dan Bernhardt, for those of you who remember Dan when he was here. So after graduating, he worked at Goldman Sachs for a while, mostly doing kind of M&A stuff. So M&A in the 80s was, you know, a good thing to do. He's now the senior managing director and founding partners of Touchstone Partners, which was formed in 98 on those. And then closest to me is Brent Tran, who graduated in 2000, worked as a portfolio manager at Lazard for a while, and then is now the head of risk management at Cantillon Capital Management. So that is our 4 panelists. So if we could take a moment just to welcome our 4 panelists. So our plan, such as was, we give each of them a few minutes to say a few comments, sort of unrestricted at that point, and then afterwards we'll take some questions. Bill, did you want to start on those? Bill actually had some slides. Let me turn over to his slides.
I feel a little bit disoriented. I was up from 1:30 a.m. Because my Japanese short pigeons were really killing me, and so I might be not very focused. Or ask for forgiveness. As Bryan said, sorry. Okay. I grew up in Korea. I came here to the States when I was in high school. Went to UCLA and wanted to come to smaller school and good school, so I came to Carnegie Mellon and went to New York in 1990. So started out as at a Korean company, and then back then I really didn't understand asset management industry. One thing that I knew out of business school was I really wanted to go to New York. So I didn't care what kind of job, and so I was very determined to go to New York, and I went to New York. You know, it's not Goldman Sachs and so forth, but you know, that was my goal, and I went there. And then I worked at Peregrine. There was a very high-flying, Hong Kong-based, China-focused shop. Did very well for a while, and then went bankrupt. Right before they went under Tiger Management, which was founded by, I guess, very well-known investor Julian Robertson, whom I worked with as a salesperson for a long time. Out of the blue, offered me a job, and that's how my career started. So a little bit of different background than typical Tiger people that mostly came from Morgan Stanley, Goldman Sachs, in M&A practice. So I was there for a while, and you know, Tiger went through some difficult time, and Julian Robertson basically in 2001 asked me to start a fund, and that was out of the blue as well. And my response to that was, why? You know, I'm happy being your analyst. You know, I know we're not $20 billion hedge fund anymore, but but he said, Bill, I think you're ready. Let's start with your money and my money. And so that's how it got started. And in fact, this is a little bit disoriented because I used this at Goldman Sachs. So, sorry. Right now, Tiger Asia Fund, I guess since inception, we only did 3 markets: Korea, Japan, a little bit of China, and domestic stocks only. What I mean by that is we only look at companies that generate basically 100% of revenue in the domestic market. Why? Let's say Toyota, Samsung Electronics. I used to do that at Tiger Management, but when I started Tiger Asia, I had to face the fact that I don't have offices in London, Silicon Valley, Tokyo anymore. So why, just because I'm a Korean, there shouldn't be a real reason why I am the best in Samsung Electronics. So I said, okay, I'm gonna cut down my industries and countries to the level that I could say to a lot of investors, because of my experience and Tiger's contact, that we are the best in the world. So I narrowed it down. Right now, we are managing $1.2 billion only in those 3 countries, in only those sectors, and we are currently closed, not looking for new capital. You know, I'm sure we're going to have a very exciting discussion, so I'm going to just focus on just few comments that really shaped my investment philosophy or just, you know, everyday life discipline. These are the few words and some comments that Julian Robertson made to me and few analysts over my work experience there. Julian and I still share the office at Park Avenues. So it's continuing, but these really are some of the principles behind my thoughts and our discipline. I think it was a first day or second day of the job at Tiger, and he called me up, and he said, "Who do you think you are?" Okay. And, you know, I was very, very shocked. You know, I was, you know, trying to settle in, and what happened was, there was some visitors for me waiting in the lobby, maybe arrived about 5 minutes ago. And I was busy kind of finishing my phone calls and so forth. Julian called me up and basically said, "Bill, listen, these are great people trying to help us. You cannot have these people wait out there, and you cannot waste these people's time." All right, so just second day, there's a good lesson for me. You know, back then, running $7, $8, $10 billion hedge fund was a big deal. Nowadays, there are a lot of shops like that. You know, in the mid-90s, it was Tiger and Soros and everybody else. So there was a little bit of shock to me. And during the bubble era, he said, you know, a bunch of analysts, at the peak, we had about 40 analysts. And it was bubble era. Every day, stocks were going up, and nobody was giving Julian short ideas. You know, long. And then you know, we had these Friday lunches every Friday. And he basically said, "Gentlemen," it's really gentlemen because we really didn't have any ladies. He said, "Gentlemen, I expect to lose money on shorts." And I thought back then, you know, what a crazy remark is that? A money manager saying, "I expect to lose money." That's kind of insane. But over the years, especially when I began running my own money, own portfolio since 2001, I say that to my analysts and a lot of people. Because as a hedge fund guy, especially with a price target driven strategy, which tend to be longer term, we have to short. That's our blood, and that's what we do. And many times, you know, sometimes I have that temptation when, you know, Japan is up 40% last about 3 months, and I'm net short Japan. And one of the few guys who probably stupid enough to do that, but that's what I do. And third comment came when we were, you know, flying high. Julian went into macros, And there was a day we lost $2 billion. It was a yen trade, you know. It was going very well for us. Some analysts were saying yen is going to 200 and we're going to be just billionaires, every single one of us. And then yen appreciated substantially, and everybody was panicking. Again, another meeting, and Julian came in and said, you know, guys, calm down. It's only work. We do our best. Times like this, make sure you look after your family, and let's do our best. And then, you know, the bubble lasted a lot longer than we expected. You know, Chinese bubble in the mid-90s lasted 12 months, 6 months to 12 months. This thing lasted 18 months. So there was a lot of departure among the real smart analysts. And, you know, people were questioning Julian. You know, I was too. And he basically said, okay, I'm going to quit. I'm going to return all the client money because I do not understand this market. Rather than change my discipline, I'm going to quit. And lastly, that was a very interesting thing. You know, Julian made a lot of people so much money over 20-year span. And then the loyalty went on as far as about 18 months. Of course, there were people who were willing to stay on. But so the one thing that Julian should have done differently, in my humble view, is that he felt he was pretty invincible. So he made everybody have the quarterly redemption. But looking at our asset side, investment side, you know, we were looking at 12 to 24 months. So we had that asset liability mismatch. And that's one lesson that we learned from there. Okay, so let me stop there. Thank you.
So, Remo, did you want to say?
Sure, just a couple words.
Sure.
Can I sit here? Do you want me to sit
Feel
there?
free to sit.
All right, okay, great. But before I give you a little bit of background, I first just maybe I show of hands. That hedge fund sounds pretty impressive. Who's on the hedge fund club here? Just a show of hands. All right, great. And some of the faces in the audience look familiar. I was here earlier in the year recruiting for our firm. So maybe by show of hands, how many first years do we have in the room? That's good. Second years. Alums and faculty. So guys, those are the people we don't want to answer questions for. We might be in trouble. But anyway, my name is Remo Jolly. Some of you do know me. Bryan gave you a brief background on who I am, maybe just to go in a little more detail. I graduated in '95. I was actually working at Westinghouse, and they sponsored me to go to grad school here. I went to undergrad just next door at Pitt. When I was at Westinghouse, I basically was in the treasury group and had a great opportunity to do a lot of different things, from working on a revolver when we were in the crunch in '93, and you know on death's door of bankruptcy. Worked on the acquisition of CBS, and then also the last thing I did was manage the FX book for Project Finance, which was around $2 billion. I was always I was an accounting management major undergrad, so coming to CMU was a little bit of a departure from my skill set and strength, which was not as quantitative. But I heard so many great things about this franchise, and since I was here in the Berg, starting to become a Steeler fan, and the university was so close, I thought this was a great opportunity to kind of check things out. And as I got here, I started to fall in love with the place for a lot of the right reasons. You're around smart people, both in the seats next to you and also the professors teaching you. I think one of the things that excites me about being here today is, unfortunately, at that point in time, there weren't a lot of people on Wall Street. And Wall Street, even though I am from New Jersey, I didn't know anything about New York and lived in Pittsburgh for 9 years. So I kept scratching my head. It's like, what's going on in Wall Street? Why does everyone want to go to Wall Street? I didn't know what a hedge fund was, didn't know what a long-only manager was, and most of all, I didn't know what broker-dealers did or investment banks. But I knew everybody wanted to go there, and one of the reasons I want to go there is because I want to get paid. Call a spade a spade. I didn't want to do it because I want to work 80 hours a week. I really thought this would be a good place to kind of get to where I wanted to go. So in '95, I graduated. I got an opportunity to take an offer at this boutique investment bank broker-dealer, a firm by the name of Bankers Trust. Anyone familiar with Bankers Trust? I know maybe the panel here, you know bankers. Jerry?
Absolutely.
Sure, you as well. So that was, Bright Lights, big city, like the movie. I got there, I was really excited coming to New York, and I realized, all this money that I'm making, I was still in the negative. I was barely making the equivalent of minimum wage when you live in New York City. But it was a great experience, I was learning a lot of different things. I was in the associate program, which I think, as some of the students, first years and second years, and maybe some of the alums can attest to it, when you look at the alternative investment community, if that's an area that you want to go try to conquer, being in one of these associate programs is a great way, is a great stepping stone into that next eventual career. So I was in this associate training program for a year, year and a half, and this is 10 years ago, and I still don't know what a bank broker dealer did, but I had an opportunity to join institutional services, which was one of the bigger groups within Bankers Trust, and stepped out of the associate program. And from there, that's when I think I started to get my first taste of what hedge funds were all about, in agency lending, then in derivatives, and then I guess I think 98 that's when LPCM happened. That's when Bankers Trust was really impacted because of some of the positions that they had on, and suddenly from $130 stock, it was down to like a $60 stock, and suddenly I think the Fed stepped in, and unofficially, I guess Deutsche was a suitor for our business. And from working for a boutique broker dealer that's a U.S. company, I was working for this behemoth called Deutsche Bank. And then I moved to the structured products area, and it was funny because Deutsche had no real presence in the U.S. hedge fund, or I'd just say U.S. Sales and trading space. But very rapidly, they started to send a league table. And I felt very fortunate to be someplace before the trend started happening. And that was like in 99, 2000, when hedge funds, after 98, were still making a comeback, but more on the equity side. Pre-dot-com, you had ConvertR, and this is where you started learning about structured products, financing, derivatives, and it was fantastic for me. And then in 2000, I think it was 2001, 2002, the folks at Citigroup asked me to come and join them, and as they said, the Godfather, it was an offer I couldn't refuse. So I came to Citigroup, was in New York almost 4 years ago, and then little under 3 years ago, I was asked to start up the office for equity finance out on the West Coast. So I'm based out of San Francisco. I cover hedge funds and anything in that umbrella under alternatives. I think one of the things Bryan did prior to this panel, he kind of set a roadmap of some of the questions that hopefully we'll talk about today. And it's going to really be important for you guys and gals, alums and students, to ask those questions. That's why we're here. Because now this quote, hedge fund, unquote space is really morphed into private equity, long-only funds. One of the things Bill mentioned was asset liability mismatch. And when you think about that, and we'll talk about it a little more, this is one of the reasons why I think we're seeing such a morphing of what was historically siloed investment practices. So hopefully we'll talk about some of that stuff today, and please bring on the questions. I think we're here for you guys, and hopefully this will be fun and interactive for everyone. So,
great, thank you.
Cool.
Yeah, my name's Jerry Temas. As I said, as Bryan said, I'm co-founder of Touchstone Partners. I co-founded it in 1988 with another GSIA, Tepper alum.
Yeah, here.
Co-founded Touchstone Partners with another GSIA alum, Larry Jennings, who's now a trustee of the university. I should probably do one more poll. Rimmel did a couple. How many old alums we have here? Tallahassee style, classmate of mine. I scanned the crowd for familiar faces. Tal's popped right out of there. But just a little bit on my background. I graduated from University of Michigan in 1978. Ultimately ended up at Carnegie Mellon in the PhD program. Like Remo, I'm a bit of an accidental investment banker. I really didn't know about investment banking until I got here, and really didn't know about it when I got here. It was an evolutionary thing. I arrived here in 1980. Was in, as I said, in the PhD program, and around 1983 decided that these things these MSIA students were doing seemed pretty interesting to me, and so I piggybacked the MBA. I got done with the MBA in 1985, almost done with my thesis, and I got an offer from Goldman Sachs to work in their capital markets and mortgage finance area, then later financial institutions, and finally mergers and acquisitions, and was a founder of their principal investment group called GS Capital. That was around 1990. By 1992, I had a growing family. I now have a wife and 4 kids. My wife is also a GSIA alum, class of '84, and I think we've got some Carnegie aspirants among my offspring. But we moved back to my hometown of Detroit, and I started an investment bank called GC Temas and Company. It is now not much more than a legacy company of our Touchstone partners, but it was my first foray as an entrepreneurial investment banker, and building a business from whole cloth. We focused at that time on boutique transactions, regional middle market M&A, financial advisory programs, but my heart had always, once I was exposed to principal investing at Goldman Sachs, my heart was in principal investing, and at about 1997, we've been doing a fair amount of work with Cargill out of Minneapolis, and for those, I'm sure you've all heard of Cargill. Cargill is the largest privately held company in the world, $56 billion, probably more, in revenues a year. But they've got a very sophisticated financial services group. Service is probably a misnomer, it's really proprietary investing arm. But they asked me to co-invest with them, and that was an offer that I couldn't refuse. So at that time we started Touchstone Partners. I contacted Larry Jennings, who was a good pal of mine and somebody who I respected and felt like I'd like to throw my chips in the water with, and we formed Touchstone Partners. Touchstone Partners is, by standards of my fellow speakers, is a small fund. We've got about $160 million under management, but where we are in our development is, it's probably a misnomer, but we believe we're at an inflection point. I think we're probably more aptly a point of convexity. We feel like we're growing, in our experience has been that we're growing progressively faster in terms of assets under management. We focus on, we're in private equity, and I think we all have a point of view on the distinction between hedge funds and private equity. I would say that the distinction, and I'd like to get into this a little bit later, but the distinction is largely a contractual one. I don't think that the appetites of the fund managers are much different, but we can get into that. But we are in private equity. We consider ourselves value investors. We've seen value in distressed loans, and so over the past 6 years we've bought over 4,000 distressed loans or bonds. And in order to accommodate all those positions, we're largely in a control position in virtually everything we get involved in. We formed an asset management platform called Touchstone Asset Management, and Touchstone Asset Management is a rated special service, rated by S&P. So just at the top of the pyramid, we've got Touchstone Partners. which is a registered investment advisor with the SEC. We've got 3 going on 4 touchdown opportunity funds. Those are all, up till now, those have all been what we call qualified funds, meaning they only admit qualified investors, investors with either individuals with more than $5 million or institutional investors with more than $25 million of assets to invest. We also have, as I said, Touchdown Asset Management, which is a rated special service. Thank you.
A few opening comments?
Sure. Hi, Brent Tran. I graduated in 2000. Got to work either. After I graduated from GSIA, I went to work for a company called Lazard Asset Management. It was the asset management division of Lazard Frères, a French investment bank. I was recruited in there to essentially run a mutual fund. So a month after I graduated, they had given me a pile of like $300 million and said, here, you're managing a mutual fund now for some British and French investors. I did that. About a year later, I was doing research and looking at my investment processes on how to make money. I noticed that there were 2 guys down the hall that were managing a hedge fund for Lazard. It's a very small internal hedge fund. But in 1999, they had generated 180% returns for their investors. So we started talking, and then shortly after that, myself and a colleague launched a US-focused long-short equity fund for Lazard. We grew that and managed it through the end of 2000. We had some issues with our compensation from the executive board of Lazard, so we decided to all leave. So a group of 8 of us were managing $3 billion left at the end of 2002. We all had to sit out our non-compete agreements, and in the middle of 2003, we formed Cantillon Capital Management, launched with $3 billion. About 70% of that came from old investors. We manage global long-short equity portfolios, and today we're managing $7 billion. My role there is I'm head of risk management. I essentially work with all the portfolio managers on how to structure the portfolios, how much capital to allocate to each trade, and just managing the portfolio through volatile times and non-volatile times. So I also want to add that any comments I make here are my opinions and do not reflect the opinions of Cantillon.
I'm going to ride that statement as well. So,
Sorry. There's not like a video camera in here keeping track of everything you say. There's no worries on those. So thank you, Brent. So let's open it up to questions. The rule is your question has to be loud on those, because repeating questions misses nuances. So ask your question and ask it boldly on those. It can be a timid question, but you must ask it in a bold fashion. Or a bold question in a bold fashion. Take your pick. Steve?
Following up on kind of lead that Jerry introduced, I mean, you read a lot these days about a so-called convergence between hedge funds and private equity funds. I wonder if any of you could comment on what exactly that means, whether it's true, and what impact it might have on the industry.
Since you mentioned my name, I'll start, but I think every one of us has got an opinion on this. Hedge funds, first of all, it's a term that's thrown around. It's lost its meaning in many respects over the years. Hedge fund used to mean just what it said. It was a fund that employed a hedge strategy to make money, maybe arbitrage in various markets. But today a hedge fund is different from that. Hedge funds, the principal distinction between a hedge fund and a private equity fund today in conventional parlance is a contractual one. And hedge funds typically allow for liquidity events amongst their investors, and I think Bill had alluded to that earlier. They also, as distinguished from private equity fund, often are forced to take down their money all at one time. Private equity fund, our fund, we take down the money for 5 years at a time, and then we have a 2-year extension after that. Our takedown of the money is more on a just-in-time basis. So if we need money, we make a capital call. Now what that means is that if you're a hedge fund and you take all your money down at one time, you need to deploy that money pretty quickly. Otherwise, you're going to have funds lying fallow, and your returns are going to get killed. So hedge fund investors, in my experience, have been very aggressive about putting their money to work. Once they put it to work, because they've got these periodic redemption requirements, they need to deploy it in such a way that they can liquidate it if they have to, without getting penalized. Private equity, we have the luxury of putting our money to work in illiquid situations, and in many respects, that is what I believe the role of a private equity firm is. Over the years, I think that hedge funds have looked at the returns that one can get in the illiquid markets, and lusting after those returns have changed the contractual nature of their operating agreements, which is what governs how you manage your fund. The current operating agreements in the hedge funds that I'm acquainted with, and everything I'm saying is anecdotal, I'm sure we've got other points of view, but the hedge funds that I'm acquainted with generally have long initial lockout periods. So once the money is taken down, yes, there are liquidity events, but it's no longer quarterly, like in Julian Robertson's day, but you may not be able to take your money out for 18 months. Then the redemption periods, that may itself not be quarterly. It may stretch to 6 months or so. And then finally, once, if an investor comes and requires a redemption, there are what I feel to be nuanced penalties that those investors incur by early redemption. For instance, you may be allowed to redeem after 18 months or every 6 or 9 months after that. Once you go for your redemption, they can redeem you over a period of 6 to 9 months and maybe not pay you much of an interest rate on that. But there are various ways that the hedge funds that I'm acquainted with have attempted to converge the contractual terms of their documents to the contractual terms of the private equity documents. That has allowed them to pursue investments in more illiquid markets.
Maybe just to add on that, first and foremost, absolutely, definitely, and these are just observations, there's convergence, right? And it's going 2 ways. There's 3 different types of investment management philosophies, right? There's long only, that tend to be more beta allocation, and then there's hedge funds and private equity. Maybe we can focus on the last 2 first. And the trend that you see, that I've seen with hedge funds and private equity is you've got hedge funds that want to be private equity. Maybe we can start with that. And why do they want to do that? And I mean, that slide that Bryan had shown at the onset of the presentation shows just such a rapid growth in capital. And there's a lot more hedge funds. I think it was the one after that, the one after 2008.
They're both the same picture.
Sure. But the point is, there's a lot more capital flowing after ideas, right, and opportunities. So what does that mean? In the public markets where hedge funds historically have operated, it's becoming more crowded. So now what's happening is you're seeing the bigger hedge funds starting to go after private equity because it's a new frontier of alpha, for lack of better words. And you know, I guess the philosophy is the logic set in selection is not much different than looking at a public equity firm or public investment opportunity. The second thing, when you have a hedge fund that's moving into private equity, and again, observation, is something Jerry alluded to, is lockup. And something Bill alluded to earlier is that asset liability mismatch, or a mismatch. There could be opportunities both in the private and public markets that hedge funds feel could be a home run for their investors. However, they've got to manage their client liquidity, i.e. they have to manage this risk of possibly a client redeeming inside a quarter, redeeming inside a year, when the investment time horizon could be much longer dated than that. So now when you have hedge funds that are going to private equity, they're going out to their clients. Is anyone familiar with side pockets? It's becoming a hot new word in the alternative space. So it just basically, it's a way,
I missed it.
Side pockets?
I don't want to miss a good buzzword. Side pockets?
I don't know if it's my buzzword, but
It really helped when I can throw those out, right?
But yeah, it has nothing to do with pool. It's really for hedge funds that basically have illiquid investments, and they segregated from their liquid portfolio. Should I use? Can everyone hear me?
Yes.
So okay, this is just deafening people, I guess.
Just leave it there. It's good.
But anyway, so you have hedge funds that are have these side pocket carve-outs now that they can invest in liquid investments, and it doesn't and their investors know that, and they say, hey, if I'm putting any money into some of these illiquid investments that are quote side pockets unquote, that's not going to affect my the capital that I'm redeeming from. So it's definitely a trend that we're seeing, and then, so now you got hedge funds migrating over to private equity. Those are two observations. The other way, you've got private equity firms that are migrating into hedge funds, and why do they want to do that? I mean, and again, I'll just keep it simple. Two observations I've seen. One, and Jerry, hopefully you can confirm or deny. There's not a lot of deals that come to closure for private equity firms. They'll spend a lot of time researching companies, but they don't, they might research 100 companies, but they might actually invest in, inside 10%. So what happens with all that research and time in evaluating that industry? That's gone, it's for naught. So I think when you see private equity firms today, and again, just an observation, I think they're thinking, hey, look, they have all this research. This is another way, if we create a hedge fund product, for us to leverage the research we've already done and garner some of the insight we have in that industry or market. The second, and I kind of said it in why I came to Wall Street, it's about money. I think it's becoming harder and harder for private equity firms to retain top talent, because the way they get paid, it's they don't get paid till like 9 to 10 years or after the lockup period. So now if they have a hedge fund construct, there's the payments in terms of how the management fee, the performance fee is much more frequent, and it allows them, it gives them more buying power to retain top talent. I mean, is that something you've seen as well?
They consider some points.
Yeah, I mean, those are my points. So.
With respect to the one point you made, private equity going into hedge funds, we've had promoters. In our business, you have to go out periodically, and I'm a little closer to the ground than these guys. So if the SEC's in, I know about it. If we're out fundraising, I know about it. But when we were out dealing out with our last fundraise, we had a promoter that was interested in working with us, and this goes back to 2004. But in 2004, this guy was pleading with us to recharacterize our product as a hedge fund, to give some, at least the perception of some periodic redemption events. And why? Because hedge funds were hot, and he thought that we could raise a lot more money as a hedge fund than as a private equity fund. So from our perspective, it was just it was a marketing device, and we elected not to. We just wanted to. We kind of know who we are, and we're going to stick with that. But so in some sense, why would a private equity firm migrate over to hedge fund? Yeah, marketing. Secondly, compensation. Compensation. Yeah, we get compensated, hopefully handsomely, at the end of our lockups, which are 7 years long, and that's. That it's different in the hedge fund industry. I think that hedge fund managers tend to harvest their carried interest. Is that a familiar term to everybody? Hedge fund managers tend to harvest their carried interest over time, whereas private equity firms wait till the...
We get paid annually.
Yeah.
We like that.
I mean, one issue these guys are raising here is, that you should be asking is why are hedge funds so popular right now? I mean, hedge funds have been around for a very long time. The first one was started by Alfred Jones, who was an editor of Business Week in the 60s. He went out and he bought some stocks and he shorted some stocks and he said, I'm hedged. And he had spectacular returns, but they've been around for a very long time. Tiger was a very big hedge fund back in the 90s. Soros was a very big hedge fund, but there weren't 8,000 hedge funds back then. If you go back 10 years from now, there were probably 200 hedge funds, and 85% of them were good hedge funds. Right now, there are 8,000 hedge funds. Maybe less than 10% are good hedge funds. Everybody wants to start a hedge fund right now. The fact that you have a hedge fund club here is a great contrarian indicator to me, saying that it's kind of hot right now. And I'll take the contrarian view that hedge funds really aren't that great. It's just that traditional asset management has been so abysmal for American investors and worldwide investors that hedge funds look so great relatively. If you were just a regular investor, you listen to your finance professor, forget active management. It doesn't work. Efficient markets works. Go buy the S&P 500 index fund. You do that, or maybe go buy like a small actively managed mutual fund. Your returns are horrible. I mean, you're getting a Sharpe ratio of 0.4. Most hedge funds will give you a Sharpe ratio of something over 1. You as an investor, what should be most important to you is your net of fee risk-adjusted return. So if you have somebody that can give you a 1 and your alternative is a 4, you can also I can make this argument that the hedge fund is not charging enough. A typical hedge fund is charging 2 and 20. So that's 2% annual management fee, 20% of profits after perhaps some high water mark. If he loses money, he has to make the money back up before he gets paid. But if he can still earn you a 1 Sharpe ratio and your alternative is a 0.4, he should raise his prices. I mean, he should clear the market. He should set a better, efficient market for hedge fund management skills.
So if I could follow up on that, I've been always puzzled by this. So there's quite a diversity here of what each of these people are setting, Remo, who sort of supplies on the other side of this. But the contract that that all kind of hedge fund managers and private equity managers have is really homogeneous, right? It's got this 2% varies a bit of capital and then 20% of profits, right? Which is why?
I think
Why is there massive growth in this? Why do people say, no, I don't want any more money? Right? No, my fund is, your fund was closed. There are people here who will give you money. No, sorry.
Why?
I would give you money.
Why stop?
Yeah, sure.
Yeah.
So the two questions: why do sort of funds close? And the second one is kind of why are these contracts so rigid? I mean, the 2 and 20 I think goes back to Jones, right? I mean, that was
he was 1 and 20.
1 and 20. You wish it was 2 and 25 because apparently it was pretty persistent.
Well,
but,
I mean,
so why? Nope.
Yeah, I think Brent, you might probably have a better answers for that.
I mean, I think there's a legacy issue. Jones started out with 1 and 20, so that kind of. Yeah. 2, there hasn't been pricing pressure on it right now. The fee structures that are prevalent with hedge fund managers, the range is very wide. I mean, the typical new hedge fund manager is coming out with 1.5, 2, and 20. You have Stevie Cohen up in Connecticut who charges 3 and 50. He runs a $3 billion fund. Half of it is his money. So you are paying him for the privilege of investing with him. So, but last year he returned 25% net of fees for his investors. So gross of fees he did 50. So if you can get 25 and that's after paying 3 and 50, you'll happily take that because your risk-adjusted return is so good. The point is, if you can identify managers that add real alpha, not managers that are simply just going long the market and using the hedge fund compensation structure to make themselves rich, but they're actually adding value to your portfolio. They're providing a chunk of assets that you're purchasing that diversifies the rest of your portfolio. You should pay them because that is very, very valuable to you.
Where's my computational finance students? That was question 6 on the exam. That would have got 4 out of 5.
So you just got a B, Brent.
So let's take a new question back there.
Yeah, not to set you guys off and get another 15-minute answer, so maybe just 2 minutes, but talk about
You're hired.
talk about returns. You just started getting into it. You know, Brent said there's 90% of the hedge funds are bad. How tempted will they be to peg to the index, to the S&P, and how important is volatility? How concerned you have to be with the loyalty of your investors, where they start saying everyone's charging the same thing, your returns aren't as good as the next guy's, my money's gone, it's in his.
I think it's very important.
And I said guys because I noticed there's no women up here.
Yeah, it's very important. I mean, these guys will chime in, but liquidity is very important. There are different classes of investors out there, different types of investors. Some investors have a really high tolerance for volatility. Some investors just want performance. When you go out and raise money, you inevitably go through Geneva. And in Geneva, there are all these private banks, and a lot of their clients like chasing the trends. They like momentum. And their money is very fast moving. So if you have a down 2-3% month, they're out of there. You as a hedge fund manager, to protect your business risk, this is mainly mitigating your business risk, you probably want to have a lockup in there. You want to diversify your investor base. You want to have a mixture of foundations. You want to have pension funds in there. You want to have high net worth individuals, and then some of the fast money clients. Because the fast money clients will give you the money the quickest at the beginning. They're like angel investors. They'll come out, you're launching, you have no track record, you need to raise $100 million. They're the ones lining up just to give you that $100 million.
And your returns, volatility versus the index versus?
The index really is cash. It's an absolute return strategy. A lot of times people have investment benchmarks on their funds. Well, investors do that. Will be something like LIBOR plus 5. You give me LIBOR plus 5 every year with a reasonable amount of volatility, and I'll stay with you.
So if you guys were investing in a hedge fund, how much money would you make for people running an investment? Co-investment. If you were investing in somebody else's fund, how much would you make the manager put up?
I can just speak personally, but like I have 110% of my net worth invested in the fund. I lever to go into it.
Same with us. Our first fund, again, we were creating a business from whole cloth, bootstrapping yourself into this business. It's not easy. And so of our first fund, for the first 6 months, we had 100% of the money in the fund. And then after we brought in our first institutional investors, we had a third of the fund. And we just bought them out. After 5 years in the fund, we bought them out at 3 times their money. So it was a good experience for them. It was a good experience for us. But it is, as our assets grow, the percentage of what we've got of total assets is getting smaller, but it's a substantial part of our net worth.
Where's the bottom for any fund? If people who are running the fund have 1% of the $1 billion in the fund, does that make you nervous?
It would make me feel like they weren't that invested in the fund, yes.
No, I think what matters is what percentage of that person's asset is in the fund. I would be suspicious and worried if it's below 50%. In my case, it's about 140% of my net worth. What happens is that I defer my compensation. I could defer it, so I defer, the maximum is 10 years. I defer all my compensation, and it's really pre-tax money working for me, and that's why it's that number. And
is the leverage the pre-tax investment? Is that how you get the leverage?
Right. No, it's just all deferred. So if you don't have that kind of confidence, then you should worry. But generally speaking, I haven't seen confident managers having less than 50% of their net worth, financial net worth, in their funds.
There's a term in this industry: eat what you kill. So that's what you want to do.
Yeah, I mean, that's when we deal with hedge funds that are launching, and we they ask the sell side to introduce them to capital. One of the first questions, especially if you don't have as much of a pedigree coming out of a shop like a Tiger or Maverick or any of those firms, they ask, obviously you're not going to have 10 or $20 million to put of your own net worth, otherwise it'd be a no-brainer. They ask, well, how much your net worth is invested. As long as it's significant, as to Bill's point, it gives people a lot more comfort that, not to use cliches, but you've got some skin in the game.
So there's no vegetarian version of eat what you kill? Eat what you grow, kind of a more. Take your tofu chicken.
Eat what you grow, or there's another way to say it.
Yeah. Okay. Hedge
It's
fund.
a California movie now.
Carnivores only on those. Okay. Good questions. Yep.
Is there a metric using which you can define the performance of a hedge fund manager? If you're given like 10 managers, how would you define who is a better manager and what's the time window you use to define the performance? Anyone?
Tracy?
That's a real
Please.
That's a real question. So it's not a real answer. So I think that the key here is the only way that you can put any strategy, if they're dissimilar strategies, you have to look on a risk-adjusted return. That's the common, denominator. So now the question is, do you have enough risk tools in your toolbox to understand the risk of each strategy? Leverage, illiquid instruments, sector concentration, so on and so forth. I think I don't think the market's there in scalable size to do that yet, but I think that's probably the only true way to really understand, a true comparison. Yeah. I don't know if you guys have different ones.
I mean, also, if you were considering, let's say you're managing a large pool of assets and you're considering 10 different managers, and they have different strategies. One of the first things you should do is, one, do your due diligence work on them, visit their offices, make sure they don't have business risk. A lot of new hedge funds fail because they don't know how to run a business. They might be spectacular investors, they just don't know how to run the business. They don't remember to pay the light bill, make sure the Bloomberg bills are paid. Take care of that first. Two, do a background check on these guys. Make sure they are who they said they are. I mean, there are recent stories of Bayou, blew up. Yeah. The next thing you should do is use your quantitative tools, see what the impact of each one of those funds is on your portfolio. It might not be the best risk-adjusted return, but it might be the best risk-adjusted impact for your portfolio. And that's how you should select a manager.
How big is the window? How big is the window of the performance you're looking for? Are you looking for only the last 18 months or maybe 5 years, 10 years?
You should use as much data as possible. Don't throw any away. A lot of times you won't have a huge track record to work on. Some guys come out of prop desks from the banks and they said, we've been trading this book for 2 years. Use that.
A lot of the times when you come from a prop desk and you give your returns, or you come from another fund, they'll tell you the returns, but they're not audited. So there's no validity technically to what people are putting up. And one of the things Brett talked about Bayou and Wood River, and it's something I talked to my boss about almost 2.5 years ago. It's crazy because hedge funds today are what .coms were in the mid-90s. I mean, you could go to anyone and say, I'm a .com, and suddenly you have like $5 or $6 million of seed capital. Today, and maybe not as much today as maybe in the last 16 to 24 months, if you told somebody you're a hedge fund, everyone's like, ooh, yeah, I know somebody on the inside, I'll put money in. So one of the things I told my boss is like, when we're out selling to this prospective client, it's you always want to get the next big guy or gal or fund. It's so hard if there's deception and people want to deceive you. There's nothing you can do. I mean, if there's no real test that you can really employ to hedge yourself. So it's scary, but it's true.
How did that whole .com thing work out? That all came out okay.
Well, certain people on the West Coast would say it's making a revival. So, but
this time I'm going to get in on it. This time. I missed the whole time last time. We have a question here, just right behind you. Thank you.
So you speak of the great growth, and we see it at the next reunion, 5 years from now. What is it that you think would be different in the industry, either in its regulation, its output, its performance, and its, in the way the constituents trade?
One thing that we always say when talking about our business is that we're not visionaries. We're very deal-oriented, it's deal by deal, but if I were going to take a visionary stab at where we're going to be 5 years from now, I think because of the amount of money, and I think that reporting is going to get better. All the return data, most of the return data that we see is self-reported, number one, and it's reported on the basis of your own internal valuations, number two. So, caveat emptor. Secondly, there's just been so much money going into this area that returns are bound to be lower in the future than they have been historically. There will be a shakeout, I believe. And regulation, as we all know, is going to increase. Just in the last year or so, we've had anti-money laundering from 9/11. We've had Sarbanes-Oxley going out of Enron, and now many hedge funds are going to be required to register as investment advisors with the SEC starting in February of 2006, which historically they have not. And as a registered fund, I think it's a good development.
I would supplement that with maybe 3 outcomes, 5 years from now, 10 years from now. Assets are definitely going to go up. They're targeting by 07 is going to be $2 trillion for long term. That is, I would say that's a smart bet. Assets will definitely go up. What I think will happen for a host of reasons is the number of funds will decrease. One of the major reasons, or not major, one of the reasons is it's regulation. One of the things that's deceiving with the number of hedge funds out there, I think the latest number is like 8,000. I think that's funds, but I think it's like 2,000 plus managers that advise on those funds. With hedge fund regulation, we're already seeing it, which is going to be enacted in 2006. It's going to be more expensive for someone that is managing $25 to $50 million to be registered, have a compliance officer, so on and so forth. So it probably just won't make sense for them. They're not going to be making money in profit. So they'll either shut down, they'll try to raise more assets, or they'll shut down and join another firm. So and lastly, I think what you'll see happen is I think fees are going to come in. And I think you're going to have 2 schools of hedge fund investment managers. And these are all, again, my observations and opinions. I think you're going to have hedge funds that are going to want to be asset managers and get to be 10 billion, multiple billions of dollars, where it becomes more a relative value strategy, and the way they're going to be successful is from the management fee, whether it's 1%, 2%. I mean, that you have 100 people and you're managing $10 billion. That's something to sneeze at. The other strategy is, and to Bill's point earlier, is there are a lot of hedge fund managers that know they're successful, but as you start to become too big, opportunities will not be scalable enough for you to employ. So, and I think that school of thought is going to basically say, you know what, I'll be inside $1 billion, I'll be at $1 billion, because I really am not looking to be successful based on the management fee. I'm looking to be successful and do all things for a different type of investor based on performance. So I think those are the 3 trends I'm seeing.
One comment on the regulation side is currently at Tiger, which is kind of collection of independent but friendly firms. There are 3 billion-dollar plus funds. All of us are not registered. Okay, so why not? Few reasons. One, we looked at potential questions and what SEC guys do to you. Like 30-page, single-spaced questions. from the basic, personal. For some friends who got investigated or reviewed, you typically have people from SAC who really do not have any information and knowledge. Do I want to waste my time explaining to them, about 3 days what's going on? No, and because we are not Fidelity. I could probably manage $2–3 billion, but I could ask my clients, you need to be locked in for 2 years. There's only one requirement. If I could take money from February next year and require 2-year minimum lockup, I'm home free. I am audited by big 5 firm, Deloitte. So it's really, interesting thing is people who need to raise money are registered. People who potentially are within the top 10% are not. So it's a very interesting point there.
So, question for you. I think people tend to make the wrong association. When you're registered, I think people falsely get some assurances that it's a quality firm. And I've seen this with a lot of our clients on the West Coast as well. Is it safe to say unregistered firms still have the same degree of quality assurance, for lack of a better word?
Yes, and I think what Brent said and you said, it just, you just have to know your managers. And if there's a reputation, and luckily I've been associated with this big organization for a long while, and many of my clients like the fact that I'm not registered, because they know that potentially how cumbersome that could be. And you know that. So I think registering or not registering really doesn't matter that much. I know some of my friends, Lone Pine Capital, $8 billion fund, they registered already because they had a loan-only product and many other stuff. But at least from what I see, some top managers are not registering, and it's simply because we just do not want to be bothered, and we could ask investors to be longer term.
Yeah. Bill brings up a good point here. I mean, the SEC essentially wants to regulate hedge funds to make them less opaque and understandable to them. I mean, I would say look at companies like Fannie Mae, Barings, or Enron. They're very heavily regulated companies and heavily regulated industries. Were they really opaque and understandable and transparent to everybody?
We should, John is making this motion to me. I'm not exactly sure what that means on those, but my guess is you have another event at 3:30 on those, so we should leave ourselves a moment to thank each of our panelists. Thank you for an interesting discussion.